July 2026 will be remembered as the month when an energy shock forced a reality check on an otherwise resilient global economy. Escalating tensions in West Asia, including US strikes on Iran and disruptions near the Strait of Hormuz, sent crude prices surging and reignited inflation fears, just as policymakers had begun to hope the worst was over. Crude oil experienced one of its sharpest monthly rallies of the year. After trading around $75 per barrel in early July, Brent crude climbed more than 20% by month-end, settling around $90 per barrel as supply risk premiums surged. Brent briefly topped $100, underscoring how quickly geopolitical headlines can override softer demand signals. The move was not a steady grind higher. Prices swung on ceasefire rumors, inventory data and OPEC commentary, leaving traders navigating a minefield of headline risk. The immediate consequence was a renewed inflation impulse. Energy importing economies faced higher fuel and transport costs, while central banks that had been leaning towards rate cuts were forced to reconsider the timing and pace of easing. The IMF's July 2026 outlook painted a picture of steady but uneven growth, projecting global GDP expansion of 3% for the year, down from earlier expectations as the energy shock bit. Global inflation, which had been on a slow deflationary path, stalled and in some regions re-accelerated. Advanced economies showed mixed dynamics. The US posted solid first-half equity returns, with the S&P 500 up more than 10% by mid-year. But July brought a pause as investors rotated out of crowded AI names and reassessed rate expectations. The Federal Reserve held rates at 3.5 to 3.75% and maintained a hawkish tone, keeping the dollar and treasury yields elevated. In Europe now, the picture was more fragile. The euro area contracted slightly in Q1, and while sentiment indicators improved into July, while the energy price shock threatened to erode household purchasing power and corporate margins. The ECB, having raised its deposit rate to 2.25% in June, saw markets price in at least one more hike as pass-through from oil to consumer prices loomed. Asia presented divergent stories. Now, China held its key lending rate steady, prioritizing currency stability over aggressive stimulus despite a sluggish manufacturing recovery. India and other emerging markets faced higher import bills but benefited from strong domestic demand and, in some cases, robust service sectors. Equities ultimately proved more resilient than many feared, while July saw volatile sessions and sector rotation, particularly in technology and AI-linked stocks. Broad indices held ground as investors bet that the global capex cycle in AI, defense and energy transition would underpin growth. Small caps and value segments outperformed in some regions, signaling a broadening of risk appetite beyond a handful of mega-cap tech names. The US dollar strengthened, with the dollar index hitting multi-month high as safe haven flows and yield differentials favored the greenback. The euro and yen came under pressure, reflecting both energy exposure and widening rate gaps with the US. Emerging market currencies faced headwinds from higher oil prices, though some currencies like the Indian rupee showed relatively stable, supported by capital inflows. July 2026 did not tip the world into recession, but it did expose how quickly a geopolitical energy shock can derail economic indicators for central banks, forex markets, households, and investors.